Rushanara, please.
Thank you very much. So could you, Governor, run us through when people should expect inflation to return to target? I appreciate the uncertainties, but obviously given the target is at 2%, so it's supposed to be 2%, and you're predicting up to 13%, when can people expect to see that happen? If you could just remind viewers, but also how do you see interest rates growth? We've seen a very steep increase. How do you see that happening? Is it going to evolve gradually, or is it going to be quite dramatic? Those are the two questions I think our constituents really need to understand in terms of planning and household management and so on.
I mean, can I please, I think the second question gets us quite into the territory that the Chair said at the beginning. We would always be cautious about talking about that, and we're particularly cautious about because we're into the meeting cycle, and as the Chair said, I'm very clear that nothing we say this morning can be taken as a clue on what we're going to do next week, because we've got a lot of hours to spend together to talk about that before we get there. On your first question, so going back, as Hugh said, to the profile that we published in the August report, we have inflation returning, and then, as Mr. Hollingworth was saying, going somewhat below target, really through the sort of into the second and third year of the forecast. Now, I think it's important to bear in mind as an arithmetical point here that it's an annual measure of inflation, so that you get these sort of, in effect, built-in annual effects. And one of the reasons why if you look at the August report compared to the May report, we've got higher inflation persisting into the second half of next year. That's because of the impact of the sheer rise in energy prices that we've seen in the second half of this year. So, the basic picture looks the same. It comes down, but it's somewhat delayed coming down because of these, not least because of these arithmetical effects going on. Now, of course, our target is that it should be at target at all times, but we have flexibility in how we bring it back to target. But a good deal of that is being driven by the dynamics of the energy market at the moment. And the way just to finish on that, the way we forecast energy, and particularly gas, is that we use the first part of the sort of the market curve, and then we actually fix it flat thereafter. But we have taken in recent reports to showing two versions of the forecast, with the second one having the full curve, and the full curve tends to come off rather more than the flat pattern. Unfortunately, of course, the flat pattern, if you like, has been neither of them has been particularly close to reality, but has been nearer because of the sheer upward pressure on prices, so that we keep getting this sort of pushing out of the curve. But the full futures curve brings inflation down somewhat faster. That's the difference between them, essentially.
Okay, but in essence, what we've heard so far suggests that there is going to be a major consequence in terms of recession if we do head in the direction that needs to happen. How that happens is, you appreciate you can't get into the detail, but if interest rates go on that upward trajectory, then that's very much a real issue. Can I just a question in relation to all this? Do you see, with the new Prime Minister starting her role and speculation around a stimulus, do you see, without getting into policy, do you see what would be the kind of challenges and dangers of what the bank does in terms of trying to act to bring inflation down, and what the government does in terms of fiscal stimulus and so on? Or indeed, the Lord Hammond said, former Chancellor said, that the tax cuts, that if tax cuts are given with some nearly 2,000 to high earners, that would deliver an inflationary stimulus. That's just an example of where the bank's activities could be in contradiction in terms of what government does, and not in sync. And I suppose at a time of crisis, what we do need is government policy to be in sync. What are the dangers of that, and how? Where do you see the need for action in terms of making sure that everybody's kind of going in the same direction to bring inflation down, to protect the economy from a deep recession?
Well, I think it's obviously important to reiterate that monetary policy is operated independently by the Bank of England, and of course fiscal policy is operated independently by the government.
It's not kind of isolated completely.
No,
and
insulated. As Hugh said, I mean, we obviously take into account fiscal policy as it is set out and adopted and put into place by the government. And whatever is announced this week, we will do just that. We don't know.
Very quickly, though, sorry to interrupt, but on that point, Andrew, as we know, monetary policy takes quite a long time to work.
Yes.
18 months, 24 months, or whatever. Some of this fiscal stuff may be rather quicker and more of a sugar rush than that. Isn't that a problem, though? This mismatch in timing. You might not be.
As we always do, we'll take we'll take into account in whatever is announced.
But the reality is a tax break to very wealthy citizens is going to undermine what you do in the bank if you're trying to bring inflation down, isn't it?
Well, let me just reiterate. We will take into account whatever is announced, and I think that's the appropriate thing for us to do, and that's what we'll do. And I don't know what's going to be announced, so nothing else to go on.
I'll move on to another question. The bank's previous economist, Andy Haldane, was warning as early as February 2021 of the risks of a sharp and sustained rise in inflation, even as you continue to expand quantitative easing. Do you regret not heeding those warnings? I don't know if others want to come in.
Well, I have great respect for Andy, and we talked about this a lot when he was, obviously when he was on the committee before he left the bank. What I would say is this: Andy was very focused, I think, on a number of things. One was the snapback in activity at that point in time. In other words, an overall GDP in this country. And of course, there was an initial snapback, but then that's sort of unsurprising because there was a historic decline in GDP in the first stages of COVID. But since then, the path of the level of GDP has been very slow. So, as I said earlier, we are only just above the level of demand that we had pre-COVID. Only just. It has been grindingly slow since then. Now, I do want to bring in a point Silvana made earlier, which is a global point, which is this point about the rotation between goods and services, because it's important to understand what the composition of GDP has been. And I think Silvana said it earlier rightly, that there has been a slower reversal of that switch from services to goods than we expected. That's a global point, I should say. It's most prominent in the US. That is relevant, but it's not actually, I think, to be fair to Andy, that's not the point he was making at the time. He was making an overall point. I think when I look back on it, and I do look back on it a lot, there were some key judgments that we had to make during this time. I don't think it's the judgment about overall demand; it's the judgment about the rotation that has turned out to be important. There were also, I think, some critical judgments we had to make about the labour market, some of which was when Andy was on the committee, some of which were not. But I think, if I may say, Andy was also making a point, I think, about the likely path of the rundown of the savings that were built up during COVID. Now, as I said earlier, we were looking at this yesterday. There's certainly, I think, been some rundown, but it's not been very large so far, I would say.
Right. Okay.
Can I add something, because you asked about we were still carrying out with the QE program. The evidence we have on QE and its effect on the economy is that it's very state contingent. It really depends on the state of the economy. So it tends to have a big effect when we face situations like liquidity crisis, liquidity shortages. Outside those episodes, the effect of QE on loan yields and hence on inflation and output tends to be small and short-lived. So, in a way, the maximum effect came with the financial crisis, perhaps with the euro area crisis, and back in March 2020 when we had the dash for cash. Outside of those episodes, the effect on inflation and output should be very small. But let me just say why, the argument for keep doing it is that we were subject to enormous uncertainty, so QE was acting as a backstop. In the event we had a recurrence of those liquidity effects, then QE was there to step in.
Yeah, but if I could jump in here, I voted to end QE early. Not very early, because of course I didn't join the committee until September, but I voted at the next meeting to end QE earlier than it was originally scheduled to end, in part because I thought it was sending the wrong signal about the conduct of monetary policy, and that there was a time when we were making the adjustment from the accommodative stance and a continued accommodative stance to moving in the other direction with regard to monetary policy. With all, understanding the sort of the differences in the way that QE did work, there's the initial impact effect, and then there's a flow effect after that. It does send an important signal whether you are undertaking it or not.
In terms of the signaling, however, we were very clear that we would use interest rate as the marginal instrument, and so that was the background as well. We were cutting that signaling message at the time by saying that interest rates will be the marginal instrument for monetary policy.
My time's up, but I'd be very interested in knowing if there are lessons to be learnt, and there's clearly differences of opinion here on how we go forward in terms of forecasting, given we're so far off. I recognise the Ukraine crisis is a big contributor, given there's such a big gap between the target and where we're heading in terms of 13%, but also you did reassure us previously, Governor, that the increase in inflation was transitory, despite persistent questions about that and queries about that, and I was, among others, sceptical about the transitory nature of inflation. I'm going to have to leave, but...
it's a real pity, because actually I'd be happy to answer that question, but maybe it's...
We'll follow it up. Thank you.
I think I know what you'd say, actually.
Sorry?
I think I know what you'd say, actually, but perhaps you'd like to tell us. Yeah, let me give you a minute. Yeah, tell us the transitory point.
I don't know the point. I mean, as we've discussed before, I do respond quite, forcefully to what I call with hindsight judgments. But I think you're absolutely right to say we had to make some very big judgments during this period. I'd single out very quickly the point I made earlier about the sort of the pace of overall recovery. But a lot of the big judgments have been around the fact, and I think this is where time moved on, and I think I would differ somewhat with Andy, over supply shocks. Now the transient point is this. We use the transient term when we were facing one supply shock, which was the supply chain disruption. I think that is pretty standard sort of economics with supply shocks. The problem we've had is that one supply shock was then followed without any break by an even bigger one, namely the war. And you can't, and it sort of comes to Catherine's point about expectation, you can't then say they're transient in the same way, because the time length of these things, even though they may work their way through in the same ways, is just too long. And that's the expectations point. There were big judgments about the labour market we had to make, and the two I'd single out. One was unemployment going to rise when the furlough scheme ended? Second one is the path of inactivity. Was inactivity going to come down when COVID receded as an issue? Seemed reasonable. It didn't seem unreasonable to think it would, but it hasn't.
Okay, thank you.